What if the next big opportunity in commercial real estate isn't where you'd expect? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Today, we're diving into why Tier II cities are emerging as the new commercial real estate hotspots. Across India, these cities are witnessing a steady surge in office space leasing, marking a significant shift in the country's commercial real estate landscape. As companies look beyond traditional metros like Bengaluru, Mumbai, and Delhi NCR, cities such as Coimbatore, Mysuru, and Bhubaneswar are emerging as promising growth destinations. Real estate experts attribute this trend to a combination of factors. There's the availability of skilled talent, cost advantages over Tier 1 cities, supportive policy frameworks, and the growing acceptance of remote and hybrid work models. In recent years, demand for office space in Tier 2 and 3 cities has risen consistently, driven in large part by a wave of startups, particularly in the tech sector. Several multinational companies have leased significant amounts of office space in Coimbatore, reflecting a growing confidence among global firms in these markets. For instance, State Street Corporate Services accounted for the single largest transaction, leasing 2.1 lakh square feet, with a total lease value of 126 crore 24 lakh rupees in March 2025. Not just multinational companies, over 50% of Indian startups today originate from Tier II and III cities. Real estate experts note that in recent years, these cities have witnessed consistent growth in office space demand, fueled by the rise of startups, especially in the technology sector. Leading flexible workspace operators are also expanding their presence in these markets, signaling confidence in their long-term growth potential. The migration of companies from Tier 1 to Tier II cities is driven by overburdened infrastructure, unaffordable real estate costs, and rising operational expenses in metro areas. Office rents in Tier II and III cities are 30 to 50% lower, making them increasingly attractive for businesses. For example, in Coimbatore, the average rent in the central business district area in 2024 stood between 50 to 70 rupees per square foot. Despite the recent uptick in demand and supply for Grade A office spaces, real estate experts caution that Tier 1 and 3 cities must overcome several hurdles to unlock their full long-term potential. Major challenges include the limited stock of high-quality office spaces and delays in infrastructure development. Addressing these potential pitfalls is crucial in ensuring that the office market growth in these cities does not plateau. DLF Group, a major player in India's commercial real estate market, is set to make a substantial investment of rupees 10,000 crore in commercial real estate by the fiscal year 2027. This ambitious plan aims to expand their portfolio of income-generating commercial properties and is driven by the strong demand for Grade A++ commercial spaces. These spaces are recognized globally for providing world-class quality at competitive costs. DLF is focusing its efforts on constructing office and retail complexes in key cities like Gurugram, Chennai, Delhi, and Noida. According to DLF, the investment will be spread across the current and upcoming fiscal years, with a significant portion allocated to the development of high-end office spaces and shopping malls. The goal is to boost rental income, enhancing the company's already impressive portfolio, which currently generates an annual rental income exceeding rupees 5,000 crore from its 45 million square feet of commercial properties. This includes 41 million square feet of office space and 4 million square feet of retail space. DLF's strategy involves broadening their commercial presence in urban centers like Delhi, NCR, and Chennai. With an annual capital expenditure and approval allocation of around rupees 5,000 crore for fiscal years 2026 and 2027, DLF is working through joint ventures with partners such as GIC and Hines. These collaborations are key to developing prestigious commercial properties across the country. Notably, DLF CyberCity Developers Ltd., a joint venture company where DLF holds a 66.67% stake, manages the majority of DLF's commercial assets. In addition to these ventures, DLF has partnered with the United States-based firm Hines to build a 3 million square feet office complex in Gurugram, with DLF holding a 67% stake in this project. Out of the total 45 million square feet in their operational portfolio, approximately 43 million square feet, are managed by DLF Cybercity Developers Ltd. To further enhance their commercial portfolio, DLF is planning and developing an additional 28 million square feet, of which over 17 million square feet are currently under construction. More than 6 million square feet are expected to be completed within the current fiscal year. The expansion includes the development of 2 large shopping malls in Gurugram and Noida, alongside office complexes in Gurugram and Chennai. Moreover, a data center is being established in Noida, showcasing DLF's commitment to diversifying its commercial real estate offerings. The massive mixed-use real estate project Miami Worldcenter has officially opened its doors in Florida's vibrant market. Real estate investment and development firm CIM Group announced the grand opening of Miami Worldcenter, a sprawling 27-acre, 10-block mixed-use development located in the heart of the city's downtown area. This approximately $6 billion project integrates residential, retail, commercial, and hospitality components developed by master developers Miami Worldcenter Associates, led by managing partners Art Falcone and Nitin Motwani, in partnership with CIM Group. The ambitious Miami Worldcenter master plan includes around $100 million in completed privately built infrastructure, 100,000 square feet of new public space, 300,000 square feet of retail space, and 16 high-rise towers dedicated to residential and hospitality uses. CIM Group reports that many of these components are either completed or underway, with the project set to deliver about 11,000 residences and more than 1,000 hotel rooms to the property. Anchored by downtown Miami's first Apple store, Miami Worldcenter hosts a diverse array of retailers including Sephora, Lululemon, Ray-Ban, Lucid Motors, Free People, Savage X Fenty, Posman Books, HP Sneakers and Streetwear, The Container Store, and The Spot Barbershop. Upcoming tenants include Open Bank by Santander, Skin Spirit, Blow Blow Dry Bar, Bijou et Montre, and Club Studio. Dining options feature Maple and Ash, 60 Vines, Earl's Kitchen plus Bar, Sweet Paris Creperie and Cafe, and Starbucks, along with numerous local chains. Entertainment offerings include Lucky Strike Bowling and the Multi-Sensory Museum of Ice Cream. Complementing its retail offerings, Miami Worldcenter features World Square, a 20,000 square foot outdoor public plaza and park designed to serve as a central gathering space for the community. Miami Worldcenter is a game-changing development that has revitalized a dormant and distressed area of downtown Miami and repositioned it as a vital contributor to the community and the local economy, said Shal Kuba, co-founder and principal at CIM Group. Shal Kuba further noted CIM Group's extensive experience across various types of commercial real estate, including mixed-use environments, which enabled them to quickly recognize the potential of Miami Worldcenter. We joined partners Art Falcone and Nitin Motwani as the master developers in 2011, and have proudly worked alongside them throughout the years, leading to today's grand opening, Kuba added. Operating fundamentals in Tucson's multifamily market softened during the first quarter of 2025, primarily due to an increase in supply that outpaced demand. In the past 6 months, approximately 400 units were delivered. This follows 2 of the highest years on record for inventory growth in 2023 and 2024. Despite elevated renter demand, the cumulative impact of these heightened deliveries has begun to affect operating fundamentals negatively. In 2024, the local apartment market in Tucson saw net move-ins of about 1,650 units, surpassing the combined total of the previous 3 years and marking a peak for the metro area. The construction pipeline remains robust, leading many operators to halt rent increases and offer more concessions to compete with recently delivered properties. Multifamily investment activity, although limited compared to traditional levels, showed signs of recovery. Sales volume in the first quarter of 2025 was the strongest since the fourth quarter of 2022. More properties changed hands in the first 3 months than during the entire first half of 2024, with around half of these properties located within 5 miles of Tucson International Airport. With increased activity, pricing has remained steady, with the median price year-to-date nearly identical to last year's figure. This stability is partly due to the types of properties changing hands, including smaller, older Class C assets and larger properties from the late 1990s. Cap rates have stayed within the same range since late 2023, averaging between 5.5% and 6%. Looking ahead, further softening in the Tucson multifamily market is anticipated as more deliveries are expected in 2025. Projects totaling about 2,400 units are forecasted to come online, marking the end of the recent inventory spike. With permitting slowing in 2024 and expected to continue in 2025, vacancy rates are predicted to rise to 9% this year, potentially representing a cyclical peak before improvement in subsequent years. Increases in vacancy levels might lead to another modest dip in rents, continuing the trend from 2024. Operators are likely to continue using concessions to enhance tenant retention, with average concessions in Tucson already trending higher. The increase in transaction volume in the first quarter indicates that total sales in 2025 may surpass the limited levels of the past 2 years, although some uncertainty remains. Financing costs and recent development volumes could shift the property mix towards newer properties. Traditionally, 1970s and 1980s vintage properties dominated sales in Tucson, but in the first quarter, properties from the late 1990s and early 2000s made up about 75% of sales, a trend likely to persist throughout the year. In recent news, TZ Capital has significantly expanded its retail footprint in New York City, with the acquisition of 111 Mercer Street in the upscale Soho neighborhood. This strategic purchase underscores TZ Capital's commitment to enhancing their presence in highly sought-after retail districts. The property at 111 Mercer Street is renowned for its prime location and robust foot traffic, making it an attractive investment for TZ Capital. The Soho area is known for its vibrant retail scene, drawing both local shoppers and international tourists. With this acquisition, TZ Capital aims to capitalize on the area's dynamic market and further solidify its position in the competitive retail landscape. The acquisition aligns with TZ Capital's broader strategy to invest in properties that offer strong growth potential and high visibility. By securing a presence in Soho, TZ Capital is poised to leverage the district's unique blend of fashion, art, and commerce, attracting a diverse range of tenants and customers. As TZ Capital continues to expand its portfolio, the focus remains on identifying opportunities that align with their investment criteria, ensuring long-term value creation. The acquisition of 111 Mercer Street is a testament to their proactive approach and strategic vision in the retail sector. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.